We are definitely in a time of optimism. And I think that that optimism is largely what I call man-made, relating or stemming primarily from the actions of the Fed and the Treasury to counter the economic weakness of 2020. The economies of the world and the markets of the world were cascading down in March of 2020 when the Fed and Treasury came out with programs in mid-month, and the Fed strengthens its program on March 23rd. At that point, the market was down about a third, its fastest decline in modern era. However, the programs worked and produced a rebound. The S&P ended up the year 18%, and the tech stocks were up much more than that. And the interest rate cut to zero had a profound effect, and it produced a resurrection of risk-bearing. FOMO, fear of missing out, took over from fear of losing money, and it really led to a very strong demand for security. So that's worrisome. The PE ratio on the S&P is high relative to history, and we see risky behavior ranging from the rapid acceptance of financial innovations such as SPACs, which have taken over the consciousness of many investors, to the ease of doing IPOs, especially for companies that are unprofitable, and the very great performance of those stocks on their first day. And then we have phenomena like GameStop and so forth, which and we have the heavy involvement of retail buying, margin buying, and option buying. So a lot of these taken together could be signs of a bubble. But I think that most asset valuations are reasonable relative to the level of interest rates. The lower interest rates are, the higher the PE is that's warranted. Valuations of all assets are higher when interest rates are lower, which means that the demanded rates of return on all assets are lower. So I think that the PE ratios are justified, and most assets are at equilibrium relative to each other. They just all are priced to produce below history returns. And so I think bubble connotes unreasonably optimistic psychology, and a belief that there's no price too high for the bubble asset. And I don't think that those are going on today. I just think that, as I said, all prices are up because all demanded returns are down, prospective returns are low across the board, and that means that the continuation of markets at these levels is contingent on the continuation of low interest rates. That's the primary conclusion I've drawn. One of the features of a bubble is that people conclude that every member of the subject asset class will be a success. In 1999, everybody said the internet will change the world, so you have to get involved in e-commerce. And the internet did change the world, and all those e-commerce companies, well, a few of them are household names today, but many, many are gone. And the other thing is that in my most recent memo, I did mention the fact that never before has it been more acceptable to be unprofitable. When we started, the fact that a company lost money would pretty much put it off limits. And today, it's not a problem for anybody, and people are lined up to invest in companies that are unprofitable. Well, that leads me to the old saying that this time is different. And Sir John Templeton stated several decades ago that people tend to get into trouble when they start saying this time is different. What do they mean is that the constraints of history don't matter. The normal business cycle and the normal performance of business in the past doesn't matter. And the valuations standards in the past don't matter. And as I say, when people say those things, they get into trouble. On the other hand, he allowed, back in 1985, I think it was, that 20% of the time it really is different. And that was then. And the world was a pretty static place then. And I would say right now, it's probably really different 40% of the time or 60% of the time. And the example you gave was one. So one of the things that's different this time is interest rates. Back in 40 years ago, in 81, I had a loan outstanding from a bank, and I still have the ticket on my wall. It says the rate on your loan is now 22.75%. Today, I can borrow at 2.25%. Let's talk about the changes that has produced. I mentioned the change on the effect on valuation. The world has been flirting with negative interest rates. Do you think we'll have negative interest rates, and what would be the impact of that? And lastly, when the demanded return on something is negative, its value is infinite. So how do you factor the difference in interest rates and the outlook? I've been thinking for a long time, since 08 actually, that interest rates have not been naturally occurring. Presumably, all of us as investors are capitalists, and we believe that the capitalist system, the free market system, is the best allocator of resources. But when interest rates are administered as opposed to naturally occurring, then you can't have great faith that capital allocation will be optimal. Another question that you rightly give credence to, you talk about normalizing interest rates, but what's normal? I mean, is 22 normal? Is 2 normal? Is 6 normal? When I started managing money, when I switched from equity research to high yield bonds in 1978, the short-term rate was, the T-bills were 9%. So I would say that your 6 is not high enough. But of course, thinking about 6 or 9 today, when they pay a fraction of a percent, it seems crazy. So we know we want to normalize, we just don't know what normal is. The other thing I would say is that, I think the one thing that you and I would agree on is that the big mistake today would be to make optimistic assumptions for growth and profitability and then apply today's low discount rate. That would be a disaster. We don't want to do the opposite either. We don't want to make draconian assumptions and apply 9% or 6%, because that would be nutty. But I think that we can all agree that interest rates can go up but not down. When the Fed funds rate is 0 and the Fed says repeatedly that they're not going to go negative, I think we can agree that the 40-year tailwind of declining interest rates that has lifted the price of all assets is at an end.